So you want to own a coal mine. Everyone will tell you the same thing: coal is finished. And they are almost right. American coal production peaked in 2008 at 117 billion short tons. By 2024, it was 512 million. That is a 56% collapse in 16 years. The workforce went from about 863,000 miners in 1923 to 69,000 a century later. There were 2,475 mines in 1993. There were 524 producing mines left in 2024. Every number in this business points down. Now, here is the part that should stop you cold. In 2025, one of the largest coal companies in America lost $153 million and handed its shareholders $245 million in the same year. Read that again. It lost money on paper and paid out roughly all of its free cash flow anyway. That is not a company trying to grow. That is a company being harvested deliberately on the way down. Over the next 20 minutes, I'm going to show you what it actually costs to open one of these things, what a ton of coal earns after the railroad and the government take their cut, why the miner who moves the most coal earns the least for it, what destroys the people who own mines, and the strangest fact in this entire industry, that a dying business run correctly can be one of the most cash-generative assets an owner will ever hold. Start with the check you write before any coal moves. In Alabama, a company called Warrior Met has been building a new underground mine called Blue Creek. Through the end of 2025, it had spent $956.8 million on that one mine, with another $50 to $75 million to come in 2026. Call it just over $1 billion. What does $1 billion buy? One longwall plus a fourth continuous miner unit. Capacity of 6.4 million metric tons a year, over a 40-year mine life. One mine, $1 billion before you sell a single ton. And that is the good version. Blue Creek is a metallurgical mine, the profitable end of this business, which is why anyone would still spend $1 billion in a shrinking industry. For that money, the company nearly doubles its own capacity from 7 to 13. 7 million metric tons a year, and its longwall started producing in October 2025, 8 months ahead of schedule. It sits about 300 miles from the port of Mobile, which matters more than it sounds like it should, and we will come back to why. The other kind of coal mine, the giant surface pits that feed power plants, are cheaper per ton to run but come with their own iron. A mining-class walking dragline runs into the hundreds of millions to buy and move. The largest coal mine in America, North Antelope Rochelle in Wyoming, moved just under 60 million short tons in 2024 by itself. These are not businesses you enter quietly. Then there is permission. Your mining and reclamation permit comes under a federal law from 1977 called the Surface Mining Control and Reclamation Act. Your safety regime comes from the Mine Safety and Health Administration. If you're going to put fill into a stream, you need a Clean Water Act permit on top. There is no published national average for how long all of that takes, and that itself tells you something. 3 separate coal export terminals proposed in Washington and Oregon went through state and federal permitting, and not one of them was ever approved. And once the mine is running, the capital never actually stops. The industry calls it sustaining capital, and it is the money you spend every year, simply to keep producing at the same rate, replacing drag lines and shields, moving conveyors, rebuilding haul roads. One large producer guided $170 million of sustaining capital in a single year against roughly 118 million tons sold, which works out to about $1.44 a ton. Another guided $325 to $375 million of total capital against 85 to 91 million tons, closer to $4 a ton. Hold those numbers, because in a moment you are going to see what a ton of coal actually earns, and you will want to remember that a piece of it was already spent. Labor is the other permanent cost, and it is not only money. When the union struck at Warrior Met, the strike ran from April 2021 to February 2023. 22.5 months. Now the liability nobody in the industry likes to discuss because it is the one that outlives the coal. When you dig a mine, you legally promise to put the land back. To guarantee that promise, you post a reclamation bond. And for decades, American regulators let coal companies skip the bond entirely and simply pledge their own balance sheet instead. It was called self-bonding. If your net worth was big enough, you were allowed to be your own insurance company. Here is how that ended. By 2016, $386 billion of American reclamation obligations were self-bonded, with no surety and no collateral behind them, and $24 billion of that sat at coal companies that were already in bankruptcy. Peabody Energy alone had guaranteed $115 billion of cleanup against a reported net worth of $870 million. Think about what that sentence means. The promise to restore the land was larger than the entire company backing it. So the bond came back. When Peabody came out of Chapter 11 in 2017, it arranged $126 billion of commercial surety bonds plus $14.5 million through a state pool and abandoned self-bonding even though it still qualified. And notice the gap. The accounting liability on its books for American reclamation was $471 million, but the bond it had to buy was $126 billion. Almost 3 times the number in the financial statements, because a bond assumes your mine stops today, whatever your business plan says. Every producer also pays a per-ton reclamation fee on top. 4 cents a ton for surface coal, 96 cents underground. Now the coal itself, and here you meet the number that governs this entire business, which is that there is no such thing as the price of coal. In 2024, the average American mine sold coal for $52.47 a short ton. That average is useless. Wyoming coal sold for $15.23. Alabama underground coal sold for $184.68. Same commodity, same country, same year, 12 times the price. Illinois coal went for $41. Northern West Virginia, $74. Eastern Kentucky, $94. Southern West Virginia, $12.9. Virginia, $129. Virginia, $137. What you are looking at is not a market being irrational. You are looking at the difference between a rock you burn for heat and a rock you need to make steel, and the difference between coal you can scrape off the surface and coal you have to chase 2,000 feet underground. And now the cruel part. The fact that breaks most people's intuition about industry. In 2024, a Wyoming surface miner moved 29 short tons for every hour worked. A Southern West Virginia underground miner moved 151 tons an hour. The Wyoming operation is almost 15 times more productive, and it sells its coal for 8.5 times less. Efficiency is not the business. The American industry as a whole managed 522 tons per employee hour in 2024, down almost 8% in 1 year, running at 61% of capacity. So what does the owner actually keep? Take the Powder River Basin, the productivity champion. In the fourth quarter of 2025, one of the largest operators there sold coal for $14.21 a ton, against a cash cost of $13.62. That leaves a margin of 59 cents on a ton of coal. 59 cents for digging up, crushing, and loading 2,000 pounds of rock. Now put the government next to that 59 cents. Every ton of surface coal carries a federal black lung excise tax of 55 cents, capped at 4.5% of the selling price. Add the 4-cent reclamation fee, and the federal charges on that ton come to about 77 cents. The federal taxes on Powder River Basin coal are larger than the cash margin the mine earns on it. That is not a metaphor. On the most productive coal ground in America, Washington's per-ton claim exceeds the owner's. Move east, and the picture improves, but only in proportion. In the Illinois Basin at the end of 2025, coal sold for $50.83 a ton against segment costs of $34, so roughly $16 a ton. In Appalachia, $83 against $63. High-energy thermal coal from Pennsylvania sold for $58 a ton against a cash cost of $41. These are real margins. They are also margins on a product whose customers are being demolished one power plant at a time. The states take their cut too, and they have quietly been cutting it to keep the mines open. Wyoming reduced its severance tax on surface coal from 6.5% to 6% in July 2025. West Virginia charges 5% of gross value generally, but cut the rate on coal burned for electricity to 3%, and for thin seam underground mining, it drops to 2%, or 1% for seams under 37 inches. Read those exemptions as what they are: a state discovering that it can either tax the coal or have the coal, and choosing the coal. And note who is not offering discounts. The black lung tax and the reclamation fee are federal, and they are charged per ton regardless of whether you made a cent. Which brings us to the part of the business the owner does not control at all: the railroad. In 2023, the average cost of transporting coal to an American power plant was $18.77 a short ton. The average delivered price of that coal was $46.97. Do the division. 40% of what a utility pays for coal is not coal. It is freight. On some routes, it is worse. Hauling northern Appalachian coal to North Carolina cost $38 a ton in 2023, up from $32 the year before. Think about what that does to your negotiating position. You are selling a heavy, low-value commodity, and the single largest line in your customer's delivered price belongs to a railroad you do not own and cannot replace. This is also why Wyoming, which produced nearly half of America's coal in 2024, handled only about 8% of its exports. The coal is in the west, the export terminals are in the east, and the 3 that were proposed for the west coast were never built. Exports matter because for the good coal, they are most of the business. America exported 108 million short tons in 2024, about 21% of production. Just over half of it was metallurgical. India took 23%, China 12%, Japan 8%, Brazil 8%. Norfolk, Virginia moved 41.6 million tons of it. And of all the metallurgical coal America disposed of in 2024, 51 to 47 million tons went abroad, and only 14 to 49 million stayed home. If you own a steel coal mine in America, you are not really in the American economy. You are in the Indian and Asian steel cycle. That distinction, steel coal versus power coal, is the most important sentence in this entire business. So let me put the numbers side by side. In 2024, American metallurgical coal averaged $180.02 a short ton at the mine. Thermal coal averaged $37.85. That is 8 times the price. But price is not the interesting part. Margin is. One large producer reported, for the full year 2024, a margin of $22.20 a ton on its seaborne metallurgical coal and $1.74 a ton in the Powder River Basin. That is not 5 times better. It is nearly 13 times better. The same company, the same management, the same year. 2 businesses that share almost nothing except the word coal. And the 2 contracts could not be more different. Thermal coal is sold years in advance in bulk, tens of millions of tons committed at a fixed price before the year starts. Metallurgical coal is sold against a published index, priced off Australia, in contracts of 1 to 3 years. So the strategy of every serious owner in the last decade has been the same. Get out of the rock you burn and into the rock you smelt. That is why one company spent $956.8 million on a single Alabama longwall, and another spent $226.8 million in a single year developing an Australian coking mine, and another $143.8 million buying the reserves under it. Warrior Met's 2025 sales went 48% to Asia, 37% to Europe, 14% to South America, and 1% to the United States. And in early 2026, the trade was working. Premium, low-volatile coking coal out of Queensland was around $250 a metric ton in February, and the benchmark into China reached $263.50 by the end of June. But concentrate your business into one high-value mine and you concentrate the risk with it. In 2026, the company developing that Australian coking mine cut its metallurgical volume guidance by about 1 million tons and raised its cost guidance from $113 a ton to somewhere between $123 and $133 because the mine was not performing as planned. Its shares fell from $39.50 in late March to $25, a 37% decline across 2 disclosures, and shareholder lawyers filed a securities class action, which is a claim and not a finding. That is the trade you are actually making in metallurgical coal. 13 times the margin on a single hole in the ground. Now, what destroys the people who own coal mines? Start with the obvious one, the price cycle, which does not gently correct. It cliff dives. In the middle of 2016, Peabody and Arch Coal together accounted for nearly a third of American coal production, and both were in Chapter 11. Peabody filed on the 13th of April 2016. Arch filed in early 2016. Alpha Natural Resources had filed the previous August. Alpha's self-bonds alone were $676 million, and it went into bankruptcy before its 90-day window to replace them had even closed. Then the second wave. In July 2019, a company called Black Jewel filed for bankruptcy with no warning, and roughly 1,700 miners across Virginia, West Virginia, Kentucky, and Wyoming had their paychecks bounce or be clawed back out of their accounts. 4 months later, Murray Energy filed with about $7 billion of funded debt, and something on the order of $8 billion of actual or potential legacy liabilities. Note that ratio. The pension and health promises were 3 times the bank debt. And the write-downs tell you what the market really thinks. In the second quarter of 2020, Peabody took a $14 billion impairment against North Antelope Rochelle, not a marginal mine, the largest coal mine in the United States. Its stated reasons were plant retirements, cheap natural gas, and renewables. After the charge, the entire Powder River Basin segment was carried at $742 million. Meanwhile, the federal Black Lung Disability Trust Fund sits about $6 billion in debt, with government auditors projecting it could exceed $15 billion by 2050, because when there is no operator left in business to pay a miner's claim, the fund pays it, which is to say, you. So that is the business: collapsing volumes, a 59-cent margin at the productive end, a railroad taking 40% of the customer's price, and a graveyard of bankruptcies. Now let me show you what actually happened in 2025, because it is not what the trend line predicted. American coal production went up from 512 million tons in 2024 to 525. Utility coal burn rose an estimated 45 million tons, around 12%, and the reason is the least romantic thing imaginable. Electricity demand. American power demand grew about 1 to 7% a year from 2020 to 2025, against 0.1% a year in the 15 years before that. Data centers are the driver. And the American coal fleet was running at a capacity factor below 50%, meaning there was an enormous amount of already built coal capacity sitting idle waiting. So the retirement stopped. In 2025, only 26 gigawatts of coal capacity actually retired, the least in 15 years after 8. 5 gigawatts had been scheduled. 408 gigawatts were delayed, and 1 gigawatts of retirements were canceled outright. Some of that was not the market at all. Emergency federal orders directed plants to stay available, including a 1,560 megawatt plant in Michigan, kept alive and rolling 90-day extensions, and the governor of Wisconsin put the cost of those extensions to his state's ratepayers at $117 million. Do not mistake that for a recovery. The same forecasters expect the power sector to burn 9% less coal in 2026 than 2025, and production to fall to 111 million tons in 2026 and 492 million in 2027. And when Washington cut the federal royalty on coal from 12.5% to 7% in July 2025, one large operator explained that both its revenues and its costs fell as a result, because many of its contracts required those policy savings to be passed straight through to the utility. The government cut the royalty, and the customer got the money. The Congressional Research Service put the broader lesson more bluntly. The last round of executive actions favorable to coal did not reverse plant retirements, did not increase employment, and did not increase production. There is one more thing worth knowing before you decide whether you want this asset, and it is about how little of your world actually runs through it. Burning coal takes roughly £1 and a bit to make 1 kilowatt hour, and delivered coal cost American utilities about $48.93 a ton in 2024. Which means the coal inside a kilowatt hour costs somewhere around 2 8/10 cents against an average residential price of 16.5 cents. The rock is about 1/6 of your power bill, and of the money that does reach the coal, the railroad takes more of it than the miner. That is the whole shape of this industry in one sentence. Everyone in the chain is bigger than the person who owns the whole. And here is the detail that makes the bankruptcies less tragic than they sound and more cynical than they look. When Black Jewel collapsed in 2019 and 1,700 paychecks bounced, its 2 big Wyoming mines, Bel Air and Eagle Butte, did not close. They were sold, and in 2024 they produced 14.6 million and 11 million short tons under a new owner. The mines survived. The company did not. In this business, the coal, the permit, and the bond outlive whichever balance sheet happens to be holding them, and the owner is simply whoever is standing there when the cash is flowing. Which leaves the real answer to the question we started with. If you own a coal mine in 2026, you are not buying growth, and everyone involved knows it. You are buying a declining stream of cash from an asset nobody will build again, and your job is to extract that cash before the plant at the other end of the railroad closes, which is precisely what the industry now does. In the 2025, one of the largest American coal companies reported a $153 million net loss and returned $245 million to its shareholders in the same 12 months, roughly all of its free cash flow, including $224 million of buybacks that retired about 6% of its own shares. That is the whole thesis. The mine is not a business being built. It is a business being drained on purpose with a reclamation bond at the end of it, and the only question that matters to the owner is whether the cash comes out faster than the coal runs down.